Well, amidst extremely high inflation and the Bank of Canada scrambling to try to get it under control, Tiff Macklem, the governor of the Bank of Canada, gave an interview where he says that things are going to get worse before they get better.
The bank is actively making things worse. I get to make them better down the road, but for today, people are pinched.
I'm sure some of this does feel a bit counterintuitive.
So let's get into what this warning from the Bank of Canada actually is, as well as why he thinks it's going to get worse before it gets better, and what you can do to actively prepare for this. Now, first we need to get an understanding of why the Bank of Canada is doing what it's doing, making things actively worse for Canadians who are already dealing with the rising cost of living. And it might seem a little bit counterintuitive because the Bank of Canada is actively trying to make things more expensive to deal with that rising cost of living crisis. A little bit confusing, right?
Basically, the way I would explain it is demand is here, supply is here. Demand is slowing, but the difference between these two, that's still putting upward pressure on inflation. So we do need to slow the economy. We don't want to overslow it. We don't want to make this more difficult than it has to be. But at the same time, if we don't do enough, if we're half-hearted, Canadians are going to have to continue to endure the high inflation that is harming them every day.
So the Bank of Canada's number one problem right now is high inflation and how that's affecting Canadians. They're saying that right now the supply of goods and services is not high enough relative to the demand for those goods and services. So there's more demand, not enough supply. That's going to lead to prices going higher, more inflation, right? Now the Bank of Canada doesn't really have any tools to control the supply side, to make people make more things, make Canadians more productive, to produce more goods. Bank of Canada, they can't really control that. What they can control, however, is demand for those goods, because they can very easily control how wealthy Canadians feel and how much money they're going to spend and put into the economy, which is the demand in the economy. So the Bank of Canada is changing these interest rates to change the way that Canadians spend. Think of it this way: if you have a variable rate mortgage and interest rates go up, or any kind of variable rate loan, or you need to take out a new loan for something, you're going to be paying a lot more towards that loan, a higher interest rate, which means you have less money left over for other things. And the Bank of Canada says they need to do this so aggressively right now because if they don't get inflation under control and they've just been slowly raising interest rates over the long term, then they're going to have to do an even more dramatic interest rate, or this is at least what they say, in order to get inflation under control, and we'll have to deal with this inflation problem for far longer. So the Bank of Canada is saying, hey, we need to be aggressive right now. But if they do it wrong and they're too aggressive, raise interest rates too quickly, it could have major consequences for Canadians, with mass job losses as a worst case scenario. And in fact, Tiff Macklem, the guy we're seeing right here in these clips, just gave a press conference, or rather a speech here on the jobs market in Canada, explaining why this is the worst case scenario.
It's clear that this adjustment is not going to be painless. Lower vacancies mean that it could take longer to find a job, and some businesses are going to find that with less demand for their products, they don't have enough work for all their workers. But relieving the pressure in the labor market will contribute to restoring price stability.
So he says this transition is not going to be painless, and that's not going to be painless for two different groups of people. The first one is the one we already talked about: people who are sensitive to interest rates, people with variable rate loans, or people who need to take on more credit right now for whatever reason. Interest rates are going to be higher. That's going to make them empty their pockets a little bit more quickly. Now, the second group of people here is essentially everyone in Canada, because the major impact is the jobs market, right? The Bank of Canada is actively projecting that the jobs market will get worse for people who are looking for jobs. They're expecting a loosening of the jobs market, meaning that there are going to be more jobs open and potentially not enough work for every Canadian. Now, this sounds like something that's pretty awful, in a lot of ways it is, but in the Bank of Canada's eyes, they're actually looking for this as a signpost that they're doing the right thing and that their interest rates are starting to work. The first reason that higher unemployment is good for the Bank of Canada right now is that will have an impact on inflation. More people losing jobs, not enough, or not as much money to spend, means less demand inside of the economy. This is more of a pressure downwards on inflation. Now, the second reason that they want to see more job losses, more unemployment, is that they're saying right now the wages of Canadians could go up dramatically in something called a wage price spiral, which they think could make inflation even worse. You see, because there's such a shortage of workers right now, there's such a labor shortage, you're going to hear this term all over the place. They say that various companies could start offering those Canadians higher wages to do those jobs. Again, sounds like a good thing. In the Bank of Canada's eyes, it is not, because if people start getting paid higher wages and businesses sort of pass on that extra spending to consumers, and now these consumers who are getting paid more can afford to spend more on those goods and services, it sort of creates a cycle, a loop, or a wage price spiral where wages continually go up, and that puts upward pressure on inflation, the very thing the Bank of Canada is fighting against. But Tiff Macklem doesn't only see the short-term negative future, he also projects us getting out of it.
We've had fluctuations in inflation before. This is the biggest test we've ever had. But monetary policy works. It takes time to work, and we do have to go through a difficult adjustment, but it works, and we will come out of this. Growth will pick up, we'll have solid employment growth, and we'll have low inflation.
Once we get through the slowdown, growth will pick up. Our economy will grow solidly again, and with healthy employment and low inflation.
So he sees a rosy future going forward, saying that once we're through this difficult transition, we'll have the same old inflation between 1% to 3%, that sort of active band that the Bank of Canada is comfortable of. So he paints a picture of a rosy future here, saying once we're through this difficult transition, we'll get back to normal with inflation between 1% and 3%, typical employment numbers, and we'll be all good. But when you're listening to the words of the Bank of Canada, you kind of have to listen to it through a different lens, because one of the Bank of Canada's actual tools that they can use on the economy is their forward guidance, or the words they say to Canadians to instill a sense of either confidence or lack of confidence within Canadians to achieve the Bank of Canada's policy goals. In order for inflation to remain low, it's very important to the Bank of Canada that Canadians believe that it will go back down to normal and that it will remain low for the long run. So of course they're going to say this, right? If Canadians don't have faith in the Bank of Canada and they don't believe that the Bank of Canada has things under control, well, it can actually make inflation even worse in the long run, because if you think inflation is going to be high, it makes the most sense to go out and make your big purchases right now before things get even more expensive. That adds more demand into the market right now and causes more inflation and causes even higher inflation expectations, and you can see how that can get out of hand. So you can see how things are kind of balancing on the edge of a knife here, but what does this all mean for you? How is it going to impact you, and how can you actually use this information to your advantage? Now, of course, things can change, and in fact, they likely will based on the inflation data that's about to come out next week. Subscribe to the channel if you're not already subscribed. I'll bring you updates on what happens there. But depending on what we see in that inflation data, we're expecting a small uptick, but not a very large one as a result of gas prices. But depending on what happens there, if it is either higher or lower than expectations, it could have an impact on what the Bank of Canada does. They don't want to over-tighten or over-raise interest rates because of all of those negative impacts like the job losses and potentially putting us into a recession, right? So if they see that inflation has come down more meaningfully than they expect, it's very likely that they could very slowly raise interest rates or even pause for the time being. We could expect to see at the next Bank of Canada interest rate decision them only raising it by 0.25 or pausing altogether, right? Now, when it comes to the housing market, likely things are going to be slow moving for the next little while, as the Bank of Canada likely won't begin lowering interest rates unless something dramatically breaks in the economy. It would likely be a very slow quarter percentage march down to lower interest rates, meaning the housing market, once that happens, could very slowly start to see a recovery. So you can take that into consideration. Now, of course, this isn't financial advice and things can change at the drop of a hat, but it looks like for other investments like stocks and cryptocurrency, the ones that are especially risk on, meaning sort of tech stocks and the sort of high tech cryptocurrency investments, those likely will not start to do well until this macroeconomic environment changes and until we see both the Bank of Canada and the Federal Reserve, the US's Bank of Canada, their central bank, once they start to pivot and lower interest rates, that's when we could see a rotation into these sort of more high leverage, high risk stocks. So if you potentially have money on the sidelines, if you've been able to save any extra dollars and you're looking to invest, it could be a good time in the next number of months as we sort of start to see the Bank of Canada and the Federal Reserve pivot from raising interest rates to maybe keeping them the same. Of course, my advice is always to dollar cost average into the market if you're planning on doing this, sort of investing a little bit at a time, sort of dripping into the market so that you get the average of all of the volatility and all of the fluctuation. You sort of get the average entry price, and that way you can sort of feel good and not feel too bad if you could have bought lower or it ends up going lower after you buy, right? Sort of evens all of that out. But I'm curious what you think about all of this. Do you think the Bank of Canada is making a mistake here when it comes to raising interest rates? Perhaps they should have raised interest rates earlier so they wouldn't have to do it so aggressively. Or do you think that they're being too aggressive right now when we could see major job losses in the future? Let me know down in the comments. I read every single one. And while you're down there, take a look at the links in the description. If you're interested in investing in some of those things that I talked about, you can use those links to get up to $50 for free when you fund your account. But with all of that said, thanks so much for watching, everybody. I really hope this video helped you out at least a little bit, and I'll see you next time.